financial risk management.
Aiming to assist students improve and strengthen their skills in the fields that are in demand. TechAmonth 3.0 is a month-long event that will focus on technological activities, including research papers, patents, web development, Android development, Web 3.0, and a lot more.
This event is by Consumer Technology Society, CTSOC, Chandigarh University, and is co-powered by the AICTE Spices Scheme and IEEE Student Specs under the auspices of Asia's largest technical event, TechInvent 2022. Once again, on behalf of IEEE Chandigarh University Student Branch, it's my utmost pleasure to extend a warm welcome to everyone.
We are extremely privileged to welcome Mr. Maseem Ali, who is the Executive Director of Goldman Sachs and Credit Risk Domain. Sir, your learnings and experiences in such a short spell of time have surely motivated us. Thank you, sir, for taking out your precious time, and we are much obliged to have you here with us.
In the words of Warren Bennis, leadership is the capacity to translate vision into reality. This reminds me of our very essential members, none other than our esteemed dignitaries, Dr. B. Priestley Shan, Dean of Academic Affairs and IEEE Chandigarh University Branch Counselor, E.R. Sugandha Sharma, Branch Chancellor, IEEE Chandigarh University, and Assistant Dean, Professional Bodies and Co-Curricular Activities. Dr. Kiranjot Singh, Consumer Technology Society, CTSOC, Chapter Advisor and Assistant Dean of Industrial Relations.
We are exhilarated to have all the department heads and the faculty members for their valuable time by gracing our session with their presence. As it is rightly said, days are not lost when the memories are created. You will yourself discover all the colors of this event embellish us all together.
May I now please request Mr. Misam Ali to come forward and address the gathering.
Sure. Thank you very much for that, and a very good evening. So hopefully the next 45 odd minutes will be useful. I will present it from my perspective, and excuse me for that. But hopefully, you can take something back and or apply in any practical way as possible. And I think, maybe it's only right for me to start with a quick introduction of myself. So my name is Misam. I've been working for Goldman Sachs for close to about 10 years now. I have been in a few different countries. I started off in Bangalore in India first, and then I switched over to like Tokyo for a while, and then I moved to Warsaw for a bit, and then currently I'm in Hong Kong. So I'm part of the credit risk department. Although I would say anything that I speak here, I'm speaking on my own behalf. I'm not on the behalf of my firm. You guys must be familiar, like investment banks are very aggressive in terms of what we can and cannot share. So I've tried to put together a very, very simple presentation, but my intention is not for you to learn anything from the presentation itself, but rather to hear me out. Towards the end of the presentation, I've also tried to chalk some questions down so we can discuss more from like a case study perspective. So open up for any questions or answers that you guys might have. And then towards the end, if you want to ask me anything, I'm more than happy to go answer, not just from a credit risk angle, but also anything else more from an investment banking perspective. So said that, so today's topic, I think while we name the session more as financial risk more broadly, the reason behind that is any bank in the business of making money has different risks to worry about. One of them is credit risk, but you also have market risk, enterprise risk, technology risk, et cetera, and tons of other risks that, as you want to name it, you can kind of create those risks, right? Every risk is important, but ultimately what is more important is banks are in the business of making money, and to make money, you need to take risk. So there is nothing as a free lunch in the economy. And what we as risk managers do is to make sure that we take calculated risks. And what I mean by that is to understand what is it that we are getting into, who is it that we're facing, do we understand who we are facing, do we understand what is the type of transaction, do we understand which jurisdiction are we dealing with, do we understand what are the legal nuances, do we have enough support internally, and or what are the other things that generally make us feel comfortable to go forward with either a lending or whatever that we do with our counterparties, right? So I think some of the key questions that we'll try to get answered here are, what is credit risk even to begin with? Because that is a domain that I specialize in. So maybe we will focus a little bit more on that. We will also talk about how is it generated, how to think about risk, how to quantify some of the risks as well. And then I think, we will talk about like, how do you assess credit quality of your counterparty if you're running a business or whatever it is, some key things. Of course, my conversation here will focus more from how do you assess the risk of a bank, just so as to make things easier, or to kind of like relate to something more practical, because not everybody is a business owner for that matter. And then you can definitely try to take it up and then cross apply it in your own domain as you wish. And then I think, the other thing that we will talk about is, how do we review it? How frequently do we typically tend to review it? What are the things that we keep in mind? What's the surveillance procedures? And of course, towards the end, we will also talk about like why some of the legal considerations are important. Because of course, as you guys know, with any risk that you take with a counterparty, things can go wrong, things can go south, which ultimately means that you need to, rely upon your documents that you executed and or agreements that you have to, hopefully get out of that position in an amicable manner. So we'll focus on some of those things. So with that, and by the way, meanwhile, if you guys have any questions, please feel free to, just jump in. Doesn't necessarily have to be towards the end of the session, right? So what is credit risk? So any risk that is coming out of an instance where we are owed money by someone, then there is risk, because this person can go bankrupt. This person can, even though they might have the money, they might not have the intention to pay. So that is also credit risk. So that is why it's important to know who you are facing, what you're facing for, what is the risk that you're taking, what's the size of the exposure that you have with them. That's why it's also important to understand what is the product that's driving such risk. The reason behind this is, if you're lending $100, then you're expecting to receive $100 in return plus the interest on that, right? But likewise, you could be dealing derivatives. Derivatives, for those of you who are not familiar, the simplest form of derivatives is like an FX forward, which means that you kind of lock in an pre-agreed FX rate for 1 month in the future or 3 months in the future, whatever that be. But you can't determine what's going to be the final value of settlement, because FX rates are always going to be on the move, right? So the question is, how do you quantify such risk? It's not the same way that you quantify as a loan, for example, because in a loan, you're just giving money and then you need to get back. Whereas in an FX transaction, you don't know how a USD INR is going to look like in 6 months' time or 1 year time, depending on the tenor of your transaction, right? And then I think, what's also important is, what should you consider while setting these limits? Meaning, one might generally think like, I am exposed to counterparty ABC, and I'm okay with taking $100 million of risk. But the question is, are you okay with taking $100 million of risk for 1 year or 10 years or 20 years? Or what's the time duration for it? Like, your appetite is not a binary value, but it is rather a binary value by time, meaning the shorter the duration, the more you're going to know what the counterparty is going to look like. Whereas the longer the duration, we don't control macroeconomic factors, we don't control things that happen in the world. So your appetite generally needs to be smaller, right? So you need to set your limits on a step down basis, meaning you start with the highest limit and then you keep going down depending on the number of years of exposure to your counterparty. So said that, what are the two basic types of instruments that can bring in credit risk for a bank? So here I've tried to chalk down a couple of examples. So you can take a loan. A loan is the more simplest form of a credit risk that a bank takes. And here you can see that Tata Motors wanted 100 crore INR in credit, and then they were willing to pay a floating rate to Bank ABC, right? So the key risk here is obviously Bank ABC is exposed to Tata Motors because they are lending that cash. And in addition to the principal amount, they're also going to be exposed to the interest value, right? And interest value here, if you look more closely, it's not a fixed rate, but rather a floating rate, which means that, again, you're not going to be able to determine what the floating rate might look like in 5 years time or in 10 years time, right? So ultimately here your credit risk is not only the 100 crore rupees, but also the potential movement in interest rates that might happen at some point in the future, right? And then in the second example, you can see that Tata Motors, agreed this with Bank ABC, but they ultimately decided that they didn't want to pay a floating rate, right? They wanted fixed rate. But just for hypothetical reasons, let's assume Bank ABC did not agree to a fixed rate, but only could give a floating rate. What is the instrument that one could take to swap their floating rate payment obligations, right? So here is where there is an interest rate swap, where the company that's buying the swap basically pays the fixed rate and in return receives the floating rate, which they further take and give back to Bank ABC. So by this transaction, what have they achieved? They have achieved now to swap their floating rate obligation to a fixed rate obligation. So they know what they have to pay through the entire life of the swap, right? So if you think about it more closely now, so Tata Motors is now taking risk against Bank XYZ, because the floating rates could go up so high where Bank XYZ might not be in a position to actually oblige on their payments and hence might default. So this is how in an economy, each person is thinking about himself or herself from a perspective that they are exposed to somebody else, right? So there are different instruments that can bring in credit risk. So it's always important to think about it, not just from a binary value of how much is this person expected to give me, but you have to think about it in terms of size, tenor, etc., etc. Right? So if we go on to the next slide. Yeah, so here you have a little bit of a decision tree. So you do a little bit of counterparty analysis, meaning you try to look at the fundamentals of a counterparty, which we will get to in a second. And then you try to consider what is your underlying transaction that's going to determine or drive credit risk in this case. And then you have to come to a conclusion on how are you going to measure this credit risk, either it's a dollar value or in percentage terms or whatever it is. And then you have to try to combine both things together in terms of like which counterparty are you facing, what is the type of transaction that I'm looking at, what the tenor that I'm looking at, etc., etc. And then based on all the facts that you have available, you would make a decision. But before you make a decision, you also have to take into account what is going to be my escape plan, right? Like things always go wrong. If you go to a bank and you ask for a loan, they're not going to extend the loan outright without taking a collateral, right? So collateral is an effective credit risk mitigant. So likewise, if you want to avoid being exposed to somebody for more than 5 years, what you could do is you could say, hey, let's get into this loan, but let's do an optional break at the end of 5 years, right? So an optional break would be if both of you agree that you don't want to continue, so then you unwind it, which means that the person who has borrowed ultimately needs to find a new bank to give them such a loan, right? So you can do things like that. You could take collateral, you can take a guarantee from a parent, you can take a guarantee from an affiliate entity. You could do many things, right? You could set, for example, if you are facing a fund, if you're facing a mutual fund, for example, mutual fund has its performance. So you can even do a mitigant on the basis of the performance of the fund to say, if you drop 10% monthly or 20% quarterly or 30% annually, then I want to be able to call back my loan, right? So there are mitigants like this that you could effectively use to make your ultimate credit decision a little more, say, friendly to your own balance sheets, because the moment you start extending an unsecured loan and all of that, your capital charges are going to be significantly high, which ultimately will start impacting some of your CET1 ratios and things like that. I mean, you guys are, all smart, and, you probably must be following the stock markets, which talk about, what's the capital adequacy ratio and things like that. All of this depends on what's like the loan book of a bank, what's the NPL ratio, et cetera, et cetera. So the more pristine the balance sheet is, the better the stock is performing, simply because, the book is clean and, it has the ability to generate further cash, which means there's going to be growth in business, et cetera, right? So that's just an example of, how credit risk mitigants can be really useful for you. Later, I think in the case study, we will talk about some of the other types of mitigants as well, which I also want to hear you guys out to see if you can think of something more innovative. But we will get there in a second. All right, so the next slide here, I will talk about some of the key components that we have in terms of like how we think about risk more broadly, right? So starting from the country of risk, I think some of the things that we have to look at is what risk does this company face because of the company, because of the country that it operates in. Does this company have like geographical concentration in one country, or are they kind of like diversified more geographically? Because these are things that might impact the credit profile for sure. Is the country experiencing some sort of like healthy economic growth, or what is the expected GDP in a specific time span? How have things been in the past? These are analysis that you definitely have to do. But in addition to this, you also have to take into account like the legal and the political system as well, because are there barriers that this company might face in terms of like making things work, in terms of like their business plans, right? So these are things that you need to consider too. But in addition to that, I think other things that you have to look at is how effective and stable are like the social or the political institutions of the country, right? If there's too much of like beating around the bush, or if there's too much of things that don't necessarily work, that's not like a business friendly environment that people want to be in. Like people like certainty, people like strong courts, strong legal system, if you will. So that way you will see businesses thriving, right? So as part of our analysis, we also see where do companies actually operate out of, right? Where are they incorporated, who's their regulator, and things like that. And then of course economic stability is something that we have to pay attention to. Like the country have like external influences. Like if your country, if the country of our counterparty is too focused on oil, it could be something that could be taken into consideration as has an external influence depending on the demand and supply of how things work, right? So you would probably pay attention to some of those things. And then you have to say, do interest rate movements impact the company's business environment, or does it impact like the country's foreign exchange movement? So all of these things basically come into the picture when you start thinking about like the operating environment type of things. And then you think about like industry risk. And when you think about industry risk, you have to think about which markets is this company operating in. Is the business like cyclical or stable? Do you expect some sort of like headwinds or tailwinds that are coming in when you face a specific counterparty? Are they operating in a developed market, or are they operating in an emerging market? How mature is this market? And then you have to also consider like the business life cycle. Some might be at the beginning stages, some might be in the harvesting phase, some might be established companies. So you have to think about things like that as well. And then you also have to compare those against some of the peers and see if this company is at a similar point in the business life cycle too, right? And then in addition to this, you also have like competitive advantage, right? You have to think about what's like the company's growth potential in terms of like what's the population of the country. Is this going to be able to scale businesses from where it currently is? And then you also have to see how many competitors are also there in this market, like what's the market share of this company. And then you have to think about like technological substitution for that matter too. So when I say technological substitution, I mean like is technological advancement going to kind of like, where is this going to take my company, right? Like my counterparty. Is this going to become a boom, or is this going to be something that's going to be replaced quickly, which means that my profits are going to fall? Like I think classic case in point is Nokia, right? So they didn't innovate, so they kind of dropped. So it can happen to anybody, it can happen to anything in any industry for that matter. But those are some examples that you see. And then in terms of like business risk, I think, I would ask this question in terms of like two areas. One is like franchise value, and in franchise value, I'm more specifically referring to like market value. What's like the total equity or the enterprise value of this company? What's its asset base? How many assets does it have? Has it changed over time? What are the drivers? Does the company have a further capital to expand or the capacity to expand? And then you have to think about, is it undervalued, overvalued? What's its position more so from a balance sheet perspective? From a growth potential perspective, you think about any potential meaningful deteriorations that can happen in the near term or on a recurring basis? What's the operating history? And then you also potentially have to think about, any M&A opportunities that this company might get. And if so, who might be the potential takeovers from there? And then, are they expecting any, like, say, some sort of like strategic shifts from where they're currently dealing? That's also going to be important for you to factor in. And then you obviously tend to benchmark it against, other companies that you have on the street, so as for you to kind of like get a feel. And then business diversification is key, because you don't want a business that is getting too much of a revenue from a single type of business. For example, insurance companies, you don't want an insurer selling only life insurance, or you don't want a company selling only marine insurance, right? Because things can go wrong. COVID can come. Of course, we all know, there are tiny clauses that excludes payments out from insurers, but, assuming that's not the case, you could have a high mortality rate, which could impact your capital, your investments, and your company altogether, right? So business diversification is key. And then, of course, business correlation is something that we have to think about. Is it positively or negatively correlated between the business lines that we have? Like, health insurance versus life insurance could be very closely correlated for that matter, right? So that's one thing. And then you have to think about geographical diversification, like how many countries is it operating in? What's the scale of business in each one of these places? Or if it's a national company, then you start thinking about which areas does it have exposure to, what's the type of population it's catering, and all of that, like geographical, demographic. So those are things that you definitely have to kind of like take into consideration. And then you have financial risk. And of course, in financial risk, you will more broadly think about financial performance of an entity. And, case in point, we were talking about a bank, and in a bank, you will start thinking about what are its funding sources, right? How many borrowers are there? How many people are putting in their savings as deposits? You take something as a CASA ratio, which is like a current account to savings account type of ratio. So you know how much of the deposits is sticky. You see how much of the funding is diversified, meaning like what part of it is secured versus what part of it is unsecured. What's the tenor, maturity profile is something that you should look at, especially if the bank is issuing debt, because what that means is it's going to need more liquidity for that matter. So things like that. And of course, all of this then, taking into account some of the other things that I talked about before, it gives you an indication of where the profitability of such company is, right? Like how has it been performing? And then when you start comparing against your return ratios, be it on an equity or if it's an unlisted company, purely on EBITDA and things like that, you start getting a clearer picture of how this company has been growing, has it been delivering returns to its shareholders, et cetera, and not. And of course, as part of this, I think, you also have to refer to what are its policies, like what are its dividend policies? Do they want to give dividends? Do they not want to give dividends, right? So some of these things can be more, I mean, it might feel like it's more on a high level, but it depends on the type of counterparty that you're dealing with, where you have to tailor all of these angles more specifically to the type of your own counterparty that you're dealing with. I mean, of course, for big banks, I mean, like Goldman, for example, we deal with large institutions all the time. Like we're not in the business of dealing with individuals. So for us, we're looking at balance sheets and things like that all the time. And then, it's not referred to here, but I think something that you have to take into consideration is also like the asset quality or the asset risk. And when I say asset quality, you have to think about like asset allocation in a bank balance sheet, for example, how much of the balance sheet is concentrated in loans versus how much of it is concentrated in some sort of like, say, structured credit products. Are they doing anything else in terms of like their brokerage businesses or anything that they might generally be kind of more prone to? And then you also have to see what part of that assets, especially if it's loan, is in bad debts, and what's like the strategy, or what do they want to keep it under, or how do they want to cover for that? Are they going to raise more capital? Are they just going to sell some of the bad loans out? They can do multiple things to manage a balance sheet, but it's important for us to understand what the plan of such bank is. And if you ask, how do we know these things? What we typically tend to do is we tend to read through management reports, annual financials or quarterly financials. We attend some of the calls that are organized by the management, where we kind of like get a download. If we have more specific questions as a counterparty, we typically tend to get more information as well. When you speak to management directly, we often speak to the senior ranks in a specific bank, who are kind of like helping us understand their balance sheet, or generally like their business structure, etc., and all of that. Of course, you have to kind of like consider, sorry, I think, yeah, and of course you have to consider, like ultimately which geography, what's like your returns, what's your own strategy for that matter. All of these things come into the picture, because when you take a risk decision, it's not just going to be a pure risk decision. It's going to be a mixture of like a commercial decision in terms of how much money can I make. So the more the risk, the more should be your returns. You should never take risk if your returns are not going to be high. I mean, it's fundamental of market economics, but it is the same thing that's used in big banks as well, right? Of course, your benchmarking might be slightly different, but ultimately it is what it is. So I would broadly break down all of these factors into like qualitative and then quantitative factors, and then there's going to be extraordinary factors. Qualitative are everything that we spoke about, like things that we cannot kind of like put in numbers, versus quantitative, which we can put in numbers. Extraordinary is something that we can't foresee. For example, you can be dealing with a government entity. So, sovereign is not going to let an important government entity go bankrupt. Of course, they always can, but that's where you have to kind of assess with like reasonable input to see if something like that could happen or could not happen. For example, if you deal with State Bank of India, it's the largest state-owned bank. If something goes wrong at State Bank of India, you could reasonably expect the Reserve Bank of India to come in and step and help. But at the same time, if you're dealing with another bank, Lakshmi Vilas Bank, maybe they will, maybe they will not, right? So in the case of Yes Bank, they did, but if it was a smaller bank, maybe they did not, right? So you have to take such things into consideration. Here I mentioned about a bank, but it's the same thing with a corporate. A corporate could have a company which is non-performing, whereas they might have something else that's significantly performing. How much do they want to step in and help the non-performing company? You can never assess it. You could try to gauge it from speaking to the management to see what their temperature check kind of assessment is, but then you can never be sure until you get like a full guarantee from them on a document. But yeah, I mean, there are different ways of doing it. Some companies do it, some companies don't. So yeah, so basically that kind of gives hopefully an overview of how we think about risk. And I think that will then subsequently take me to the case study that I have. Here is where I do want to spend a little bit of time, where you have the questions in front of you. I will give you 30 seconds to basically just read through it. And then, we'll go through it like line by line. And then, if any of you have questions or answers, I'd be happy to hear and then guide you through it as well. Okay, so, the case is easy. It's probably way too easy for you guys, but let's think about the questions a little bit. So on the back of a recent acquisition of Air India by Tata Group, which I'm pretty sure all of you are very well familiar with, you've been approached to fund the debt component of the acquisition, and the ask is to lend to the Tata Group USD 2 billion for a 5-year period. And if you were the credit officer looking into this case, what are the key risks that you foresee as part of this lending? Does anyone want to take a shot? Actually, I think there are comments, so feel free to put it on comments as well, actually.
Those who are
Yeah.
willing to answer this question may put their answers in the chat box.
Yep. So one of the answer here is logistics of Air India not working out. Yes. But what are the other fundamental risks that you have when you give out a loan? Okay, so I'll explain this one. So there are three things in this one, right? So the first one is, as Abhishek explained, fundamental credit risk by virtue of giving money to someone, meaning Tata needs to return that cash back, or Air India needs to return that cash back to you as a bank, right? So that is the first risk. If they go bankrupt, if they don't have cash, you're not going to get that. And when we talk about credit risk, it's not only the 2 billion USD, but it's the 2 billion USD plus the interest amount that's accrued on such a loan, right? So that's the first and the foremost risk. The second risk that comes on the back of this is the interest rate risk. And here, as we spoke in the earlier part of the presentation, interest rates can be floating. And if it is floating, as time passes, it can go up. And if it goes up, then it ultimately means Air India needs to now pay more than what they might have originally envisioned it to be in the past. And now I think, I mentioned to you in the past about how do you measure such floating rate type of a thing, like even for an FX forward. So the way we do that is we use statistical tools like Monte Carlo simulation and things like that, where the input of the model is going to be historical data. And then in addition to that, we will take inputs like, the current market volatility indicators using options and all sorts of things. We will try to foresee what could be our potential exposure. So that is how you need to measure your future risk with a counterparty, because you can't just assume that my exposure is going to be 2 billion plus whatever 5% that gets accrued at a 5-year period. And then am I okay with that? That's not how we do it. You have to take 2 billion, but you have to also do this Monte Carlo simulation to see what this 5% might look like in 5 years time or 4 years time or 3 years time. You do a little bit of a chart, you calculate that, and then you compare it today to see if you think that the company will be able to pay that much amount of money in the future, right? And then I have some more answers here. So Sarthak says whether the company that we're lending to is a potential upgrowing asset rather than an NPA. Yes, indeed. And then why Air India is in a loss in the previous years. Yes, those are areas that we need to consider. But thinking about the types of risk in this transaction, the key one, which is the key credit risk of giving the loan, then you have the interest rate risk. And then if nobody noticed, there is also a USD 2 billion, which means there is an FX risk as well, right? So what is the company doing to potentially hedge that FX risk, if at all? Or are they planning not to hedge it? Which means that together with the interest rate movements and all of those things, the FX risk can also kind of make a huge loss for the counterparty, right? Like all of us know INR has depreciated 5% and 6% in the recent past. If we're thinking about a potential 5-year time horizon, they could lose a 15%, 20% on that, right? If you think about a 15, 20% on $2 billion, then it's a very significant value, right? So then we have to also try to see where will the USD INR conversion rate look like in 1 year time, 2 years time, 3 years time, 5 years time. And then you have to now aggregate the interest rate risk, the FX risk, the lending risk all together to see if you're today fine with this thing. Unless, of course, in your conversation with Tata, they say, hey, you give me this loan, I am going to go and hedge my interest rate risk and FX risk. Then you know that your potential exposure is here. Whereas you as a bank could also offer a potential solution to say, hey, look, I will underwrite your hedges on the FX and interest rates, and your overall risk is going to be so much, and then try to sell that to Tata as well, right? So I think those are some of the things that we need to consider. And then in the second question, if you guys have read this one, does the acquired entity Air India play a role in the overall decision-making process? Here is where I would attribute a lot of the answers that I've gotten on the chat, where we said, why has Air India made a loss in the previous years? Are we lending to a good company, etc., etc. So you always have to analyze the asset. We're not going to be, giving money to somebody hoping that you will be able to liquidate the collateral that you get. Like that shouldn't be your approach to lending. Your approach to lending should be, is the company that I'm giving money to, will it generate enough cash? Will it have, is the asset good? Is the asset quality good? Is that going to give me enough cash flows to pay back on the loans? That is how your mindset should be, rather than thinking, is my loan good enough? Of course, you should think about your loan, but that's, your collateral, but that's still a secondary step and should not be the primary one. And of course, as Arvind said, fundamentals of a company is the first and the foremost thing. If the company is not generating cash, or if we feel like, the company is not going to be able to generate as much cash to pay me back, then it's a clear no, right? Unless, again, if if Tata Group comes in and says, oh, I'm going to give you guarantee on this loan, then it's a different story, right? But here we've not mentioned anything around that. So you have to fundamentally assess the company. And if you now think back, that extraordinary support that I mentioned is always going to be there from a Tata Group perspective, because this is a strategic asset for the group. But they have not given a guarantee, which also means that it might not necessarily be a strategic asset. So that's where you need to draw some lines and figure things out for yourself. All right, so the next one here, what are some of the ratios or aspects that you might want to look at as part of your credit decision process? Any specific, ratios, anything that you suggest we should look at? Yeah, so I have one answer here saying P ratio. Yeah, so I have debt to equity ratio, tax. Yeah, so good answers there. So definitely, I think some of the things that we do take into account are what's like the EBITDA margin, what's like the interest coverage ratio. Interest coverage ratio helps us assess, what's the how many years or how many months does this company have cash flow to pay the interest that they owe to me, right? So things like that. And then you look at your operating cash, and then you have your and then you subtract your cash expenses. This will give you like your discretionary free cash flows, which is where they then issue dividends on to their parent company, if it's an unlisted company for that matter. And then you see what is the free cash flow. The reason why this analysis is important is not only because how much cash are they going to give you, but it's also relevant because they need to think about how much cash do they have to reinvest in their business to make more money the following year, right? So you have to do some sort of a modeling. So we do create models where we come up with our own scenarios. So we say, okay, so if free cash flow is going to be, $10 million, then how much of it is going to be reinvested into the company again? And then how much of it is going to remain free, which means that they have money for ancillary expenses to, buy a building or whatever it is. Things that don't necessarily contribute to an airline business, for example, right? So all of these things you have to think about. And then, of course, as somebody mentioned, leverage. Leverage is key, because I could have $100 and I could buy a company for $1,000 if somebody is willing to give me $900 of loan, right? Classic case right now is the Elon Musk potential takeover of Twitter, right? So the guy has 40%, 50% cash, and he's looking to borrow another 40, 50%, and then try to go on from there. So one way of thinking about leverage is your asset to equity. How much equity are you putting in against your asset? The other way to think about is, your loan to EBITDA, which means that how many years are you going to take in terms of like cash generation to be able to pay back the loan that you've taken from me, right? So leverage is a very key component. If you see motivational YouTube videos, people will always say, oh, you need to take leverage to become rich. So that's the same thing that all companies do. But of course, in a rising interest rate environment, you also have to think about it from a cost perspective, because higher the interest rates, higher the cost, which means lower the profitability, and lower the profitability means lower free cash flow, and lower free cash flow means they have little to pay you back, right? So that is why, again, you have to start thinking about interest rate risk not only in the component of your transaction, but also from a perspective of what is the borrowing of this counterparty, how much do they spend on interest expenses, etc., etc. Right. So very practically think about what are the different expenses a business is going to have, what are the things that are going to impact such things, and then try to come to a conclusion. And I think Abhishek also says asset distribution ratio projections of Air India for the upcoming years. Yes, absolutely. So that is what goes into the model to come to a conclusion on how are they going to grow, what are the different types of assets. For example, I cover like an aircraft leasing company, and one of the things I see is what are the different airlines that they're giving aircrafts to. And then I also think about what are the types of jets they have, right? Like I can think about A340s or Boeing 737s, because I'm also thinking about potentially some of these jets being taken off service because they are not fuel efficient, right? Like A380 is example. I mean, this company didn't have A380s, but I'm just giving you an example, right? So A380s is something that people are taking off market because it's not necessarily commercial. So things like that. So type of company determines what you actually look at, but it is important to look at leverage. And of course, you have to look at liquidity. And when I say liquidity, you have to think about it from a perspective of how much cash do they have at hand, because somebody could generate free cash flow, but that doesn't necessarily mean they keep that money in the bank. They can buy something, they can buy like government bonds, right? Let's assume for hypothetical reasons, those bonds are not liquid. I mean, you're not able to liquidate those bonds. Then there's no point in having those bonds. Like there's no point in having those securities and assets. So how much liquidity do they have? And then this is where you start thinking about what is the maturity profile of their debt. Because if they have a lot of debt, then all your free cash flows potentially going to be, I mean, free cash flows already taking into account your debt, but everything is just going to be consumed, right? Which means you don't have enough money to then take the loan out of this company or for potentially for them to reinvest in the economy, right? So things like that. And then maturity profile also helps you understand how the company is structured. Like typically companies issue bonds, and when they issue bonds, they have time gap between, 2 points. And the reason behind that is because they obviously want to be able to kind of, borrow at a specific time point, and then they use it over a period of time for general corporate purposes or whatever it is. So all of these things are ratios that you need to think about, analysis that you need to do before you come to a conclusion on if it's good enough for lending or not. And then the next question here, what are some of the key credit terms or financial covenants that you would recommend? Anyone want to take a shot? Okay, so some of the key things that you do is, yeah, so Arvind is suggesting credit score. Yes, credit score is for individuals, but when you're doing it for companies, you don't necessarily have the concept of a credit score. The alternative to a credit score is the Moody's rating or the S&P rating that you have. So you can always say, hey, I give you a 2 billion loan under the assumption that you're going to be rated AAA or triple B or triple whatever, right? To the extent that you fail in your ratings, which we also call as a rating floor test, then what we're going to do is we're going to call back our loan, meaning you have to give the loan back, or we will have the right to call back our loan. If you don't pay up, then we will take your assets, right? So things like that. So you can do that. You can even set covenants like you need to have free cash flow of a specific percentage. You can say, you need to keep your leverage under 2x or 3x or whatever it is. So these are, covenants that you can impose on the company to kind of protect yourself from the company borrowing further than where they already are, right? So if they breach any of these covenants, then it ultimately means that you can recall your loan. Will they be able to pay at that point is something that is still questionable, but at least you will have to think about what is my collateral also. Like when you're issuing a loan, you also have to think about collateral. Like the case that I was talking about in the event of the leasing company that I mentioned, some of the collateral that we think about is aircraft. So now you also have to think about where is this aircraft even located, when it is idle, right? Sometimes it's borrowed by airlines and it's flying, but sometimes it's not borrowed by airlines and it's just sitting in a shed somewhere, right? If for example, it's sitting in Russia right now, You can't take planes out of Russia if you're not in, if you're from one of the unfriendly countries, let's say, for example, right? So you have to think about where your assets are, what are the type of assets, do I have enough collateral, do I have, enough, like sometimes we ask for external valuations on these assets as well, because we don't have the expertise, right? For example, one of the things that we do is when we buy oil, like my bank, we sometimes buy oil as well. There is external agents that take care of like delivery and all of that, because we're not in the business of going and putting pipes to the ships against things in the port and all of that stuff, right? So there we do it on a delivery basis type of a thing, where it's from one kind of shed to another shed in a different country. So all of those things. So yeah, I guess those are some of the covenants that you can add. You can do margin ratios, EBITDA ratios, performance ratios. If you're dealing with funds, you can do like your asset classification ratio as well, meaning 50% of your asset need to be in global equities, 50% needs to be in bonds, and if the fund breaches it, then you can potentially choose to withdraw your lending, things like that. So you can do all of those things. And then I guess comes our last question, which is how can we reduce our overall credit risk stemming from this $2 billion loan? Yeah, so we have an answer here from Animesh. So he mentions hedging, diversification. So in hedging, I think it's a very broad topic, but some of the things that you can do in this specific case is you can go buy a credit default swap on Air India. For those of you who don't know what credit default swap is, it's one of those things that created the 2008 financial crisis. Credit default swaps are basically type of insurance products, let's say, where you keep paying a certain amount of money. If the underlier defaults, then you get the full notional of whatever you've agreed between two counterparties. So you could do a credit default swap versus Air India here. In the remote scenario that Air India defaults, you will get that payout from whoever the counterparty that you purchased the credit default swap from. You could do interest rate swap for your interest rate hedging, because you had interest rate risk on your loan. So you could basically kind of propose that, and then you could do an FX forward to hedge the FX rate risk that was available on this loan. So that's one of the things. And then, you could even potentially ask for a parent guarantee. In this case, you could say, hey, Tata, you need to give me the parent guarantee from your group because you have too much money there. But your entity Air India, probably, I'm not very sure about it. So you need to give me a guarantee. Sometimes they give full guarantee. Sometimes they might negotiate, oh, let me give you 50% guarantee. Let me give you 20% guarantee. Things like that. Sometimes what they do is they give you a letter of credit as well from a different bank, because the bank would give the letter of credit on behalf of Tata Group, and then they would take that letter of credit, come and give it to Air India. So ultimately, you can still draw upon that because your recourse is to Tata Group. So things like that. So you can do different things like that. And of course, the one thing that we popularly tend to do is syndication. And when I say syndication, what we mean is when somebody is taking a $2 billion loan, we don't necessarily underwrite the entire loan and sit with us. We might underwrite the 2 billion, but over a period of 2 weeks or 3 weeks, we will sell a part of that loan to somebody else. So what we would do is we would, go find 5 banks and we say, hey, take 400 million each. Of course, it also depends on, does the market have appetite to take such a loan, which is why you should, when you're underwriting it, if your underwriting standards are high, then other banks will also be happy to purchase it, because of course they also want a piece of the pie, if you will. So syndication is a very key aspect of it. And of course, for us, if your loan book is going to be only like constituted of 10 billion, you shouldn't go give 2 billion to Air India and then sit like that, right? Your loan should typically be a very small portion of your entire loan book concentrated to one counterparty. So concentration risk is key. So be it your counterparty's assets, be it the type of business, be it the type of loans that you're issuing, concentration risk, diversification risk is things that you should always pay attention to. right? So yeah, hopefully that was useful in terms of how we typically tend to think about risk. And I try to do a little bit as practical as possible to the extent that maybe it will make more sense. But let me know if you guys have any questions. I'm happy to help answer.
Thank you so much, sir, for such a knowledgeable session and by being a living example and by sharing your expertise and knowledge. My sincere gratitude towards you, sir. And certainly your address goes a long way in inspiring us to work more and strive hard in life.
Thank you very
So
much,
now we
and
would like to
best
have
of luck.
so now we would like to have a small Q&A session because there are questions popping up in the chat box right now.
Yeah.
So till the students are writing their question in the chat box, sir, I have a question for you. Actually, sir, there is a perception that is going around in the market, if we talk about our friends or family, that credit usually adds a burden in our life. So how do we create that awareness among the people and how to utilize credit optimally without overusing or misusing it?
Yeah, I think, when I was talking, I mentioned in between, when you look at all the YouTube videos which talk about, you can only get rich when you leverage. It's kind of true in my opinion. It's not to say that I'm right or wrong. In my opinion, you should borrow, but you have to borrow very carefully. You will only borrow to the extent that you feel like you will be able to pay back, and you will only borrow at the beginning where you feel like if things go south, especially if you're going to be investing in something where returns are not necessarily guaranteed, then you have to be very careful and only borrow the amount of money that you could afford to lose. If I'm borrowing to buy a house, fine, you can take a little more risk, but again, you don't need to borrow, to buy 5 different houses at the same time. Like finish your first house or second house and then go into the third, fourth, fifth house, right? So my opinion is borrowing is very healthy to the extent that you know what you're doing, and you calculate what your risks are, and you're only doing it for something more where returns will be guaranteed. But to the extent that you need to borrow for returns that will not be guaranteed, take calculated risks where you're okay if that thing fails. You don't want to be back on the road for borrowing and trying something out. Of course, there are people, who feel like they have a wonderful idea where they want to go borrow and invest everything and make it big in life. There are people who take those risks. I'm not to say that's right or wrong. I mean, there's difference in opinion. There's difference in how people would approach things. But putting those extreme cases aside, it's usually useful or helpful to borrow in a limited manner.
Thank you so much, sir.
Always.
So now I have one question that how to build a perfect credit scoring model?
Yeah, so perfect credit scoring model depends on the type of counterparty that you're dealing with. So, in the case of banks, as I was telling you, you need to look at like capital, leverage, asset quality, profitability, and then funding, liquidity, all of these. And then you have to measure against some quantitative value, meaning, what is your NPL ratio? What is your capital ratio, right? I used like things like CET1 earlier in the conversation, which is like core equity tier 1 capital, right? So anything beyond 15% can be given a good score, where anything below 13% should be given like a moderate score. Anything below 11% should be given, the worst score, right? So this is one such example, but likewise liquidity as well. So liquid assets in comparison against your total assets, if it is beyond a certain percentage, you can give a high score. If as you keep going down, you keep going down. And then likewise business diversification as well. So if you take State Bank of India, for example, you see they're doing multiple business lines. So you can say, okay, if there are 5 different business lines and each business line is contributing to 20% of the balance sheet, then their business diversification is very aggressive and strong. But at the same time, if they have core banking taking up 95% of the balance sheet, and then everything else is doing only 5%, then in that case, diversification is okay, but it's not it's not the best. But likewise, if SBI is not doing anything outside of core banking, then you have to say that, their banking score is very bad. And likewise, if you look at it from a corporate's perspective, you sometimes what you do is you try to get the financials of these corporates, and then you try to create a model. And when you try to create a model, you're trying to assess, how much can be the potential free cash flow that's available. And at this point, what you need to do is in your model, you need to take into account their potential expenses. You need to think about, okay, if it's an airline, you have to look at what are the costs of changing, investment into new aircrafts. What are the costs of investing in technology for, existing aircraft to be refurbished and flown back again? Are there going to be any potential, ESG kind of things that we might to account for, where you have to do carbon offset kind of things? So these are things that you don't traditionally think about, especially in Europe, for example. If you have a company where you're producing carbon, you need to buy back carbon offsets on financial markets to make sure that your overall carbon transmission is not higher than a certain value, right? So you have to account for these things, especially things that can't be quantified easily, into your models to come up with a conclusion. But again, it's not a one answer does not fit all. It depends on the type of counterparty that you look at. You broadly have to apply the concepts in terms of liquidity, capital, asset quality, diversification, geography, etc., into whoever you're dealing with.
Thank you so much, sir.
The next question that has been asked, sir, that if we talk about the contemporary world, today's youth have started to show a lot of interest in the field of banking, investment, or credit resources, but they lack knowledge. And sometimes even the Google fails to provide the right and appropriate direction. So what we should do in that respect? What are the top information resources that we could refer for these credit risk assessment?
Yeah, so I think, the fundamental of understanding credit risk is to learn what the balance sheet has to offer. So I think the one that I started to, get interest on, or I started to build more knowledge on, is just by, reading books on fundamentals of a bank balance sheet, for example. Fundamentals of a balance sheet more broadly. So this will already start giving you ideas about what is the values that go into equity, what is the values that go into cash flow, what is the values that will go into your assets, leverage, etc., etc. Credit risk then is a function of taking all of these things and doing some numbers, taking other qualitative things, coming into a conclusion. I personally haven't read any credit risk specific books because I've just learned on the job, if you will. But definitely, as I was studying through college, fundamental statement analysis, banking statement analysis, and all of those things are, I think, things that will be useful. But that's, again, not only for credit risk. That can, be useful for any job in the financial domain. Like even if you go to investment banking, the thing that you're doing is you're building models. And to do models, you need to understand a balance sheet. If you're doing credit risk, you need to come up with a decision. What do you need to understand? A balance sheet. Of course, there are things like operations and things like that where you don't necessarily need to pay too much attention to balance sheets because you're doing more of a process kind of a job. And not to say that that's not something that one should do. I mean, people should aspire to do whatever they feel like, because there's a lot of innovation that happens in terms of operational processes, right? From a reporting perspective, whatever it is. But again, understanding a balance sheet, in my opinion, is key. And that sets you up for whatever then diversification of financial risk or financial kind of jobs that you might want to do in the future.
Thank you so much, sir.
Sure. So I think there's a question from Abhishek. He says, regarding the case study, how would syndication with other banks later work? Wouldn't we have to pitch them an even higher credit lending piece? Otherwise, we won't have profits for our bank itself. Or will we just take some credit to be lent ourselves rather than distributing it completely amongst other banks? So there are a few ways we do this. So what we do is when we're talking to Air India, what we typically tend to do is we already go and speak to 5 other banks on the other side. And then say, hey, look, this is what we have at hand. We have sourced it. We're going to underwrite it. Are you going to be interested in taking it? So sometimes even before underwriting it, you already know who's going to be interested in taking the other side of the transaction, right? In the event where we need to underwrite something on an urgent basis without necessarily somebody being aware of it, it's not again necessary that the lending cost will be higher, because you're not giving it away more generally because you're not comfortable with it. Because if you are not comfortable with it, you wouldn't have underwrote it yourself even to begin with. But what would happen is, of course, you will still lose a slight amount of money, but that slight amount of money is going to be lost from your profits. So your profits would slightly decline in the event where you're forced to de-risk your book. And that also happens sometimes because we underwrite something and then we realize that, okay, we shouldn't have done it. So we decide, okay, let's offload this risk. And in that case, because the time has passed, situation has become worse. So the new person taking it would not take it to the existing price. So they would always demand a higher price. So at that point, we might have to lose some cash to offload the risk. And in worst circumstances, we might go into a loss in that whole transaction also, in the event that this company is really not performing and stuff, which is what then ultimately gets reflected in our P&L and your kind of allocations that you do on the balance sheet for bad debts and for any sort of like problem loans and all of that stuff. So yeah, it could very well happen. I mean, what you're saying is a practical thing that all banks always face. I think there was, yeah, I think there was
in our chat box. So may I read that?
Yeah, I think it was about what message or guide you want to give to students who want to do your own startup. How should they think? I mean, if you're thinking about it from a risk perspective about how much you want to invest, I think you have to assess what your business model is. I mean, I'm not an entrepreneur, so I don't want to give you a wrong answer, if you will, or neither do I want to discourage you from, wanting to do what you choose to do. But I think whatever you want to do in life, be it a job or a business, I think you should always risk assess what you're interested in. You might as well try achieving what you're interested in and get there rather than doing something that you don't like, because you will probably 9 out of 10 times not succeed in that. But I do think that you should do some sort of like a SWOT analysis in terms of like what your business strengths are, and then weaknesses. Try to speak to mentors who can give you feedback. I think take feedback and then try to change that. Because usually people feel like, okay, my idea is supreme, and then they just go too deep into the water, spend too much money, and then figure out, okay, this is not working. I think you should figure out, try to speak to people, understand your business model, do a SWOT analysis, and then if you still believe in it, go for it. Absolutely. But again, as I said, I'm not an entrepreneur. I'm not in the business of giving loans to individuals, so I might not be good at evaluating a startup, if you will. So yeah, sorry about that.
So there is one more question in the chat box. Regarding the case study, how would a syndication with other banks later work? Wouldn't we have to pitch them an even higher credit lending fees?
Yeah, I think
Otherwise,
that's the one that I was answering before this question.
Okay.
Yeah. Cool. Any other questions? Yeah, if anybody has a question, feel free to find me on LinkedIn, ping me. I mean, I'm happy to help to the extent that I can. I can't promise to solve or answer everything, but to the extent I possibly can do something, I will definitely do from my side. So yeah, happy to help as you feel.
Yes, sir. Thank you so much, sir, for such an insightful session. And now I would like to invite Dr. Kiranjot Singh, Consumer Technology Society, CTSOC Chapter Advisor and Assistant Dean of Industrial Relations, Chandigarh University, to address us with his insightful words along with a vote of thanks and present the token of appreciation to our guest of honor.
Thank you very much. I hope I'm audible.
Yes, sir.
Yeah, thank you very much. Hi, Mr. I'm really sorry. I missed your starting. I never wanted to do that, but I missed it somehow. I must say, whenever you talk to me, and whenever you listen to me, you always feel like you have learned something new. And today is nothing like no surprise for me that I've learned so many new things from him. And I believe everybody has done it. So this is one part. And I'll always believe like Misam is not from this teaching background, but still, if you know your technical terms well, the way he explains those things, I believe he's like best mentor to me in explaining all those financial terms when we were studying. So I'm really thankful that on just one call you agreed to address all those students, and they were really enthusiastic to listen to you as well. Thank you so much for being part of this event, and we're really thankful, and we'll be looking you forward for other events as well. Thank you very much.
Oh, thank you. And for those of you who didn't know, so Dr. Kiranjot and I were classmates. So just a piece of information there.
Yeah. So like we studied for 1 year all together, and I can say this with guarantee that even you know me some or you don't know me some, you can go and ask anything. He will be always helpful, and this is what he has done this time as well. So thank you so much for being part of this.
Thank you very much. Thank you for having me, and have a good evening, guys.
Okay, I believe we have a token of appreciation as well for you. Below, obviously, it's a virtual platform, so it's a virtual token of appreciation as well. I believe Abshri, I'm not pronouncing your name wrong.
Yes, sir, it's correct.
Okay, thank you very much. So you'll please, I believe you'll be sharing the screen.
Yes, sir. I just share it right now.
Yeah.
So is it visible?
No. Not to me.
Good evening, Meeson sir. You need to stop sharing your screen. Yeah, Abhishek, it's fine
Yeah.
now.
Okay. Thank you very much, Misam. Maybe we can clap all together to thank Misam for this great session.
Thank you.
And thank you very much. We hope we'll be meeting really soon when you will be coming to India, and we'll have physical session for you as well.
For sure. Thank you very much. Thank you, guys. Have a good
Thank
evening.
you so much, sir. So we would like to have one group photograph.
Yeah.
Yes. So participants, could you please turn your cameras on for the group photograph for such a remarkable session to have a memory? We'll be sharing the feedback form soon. So we can all do this signature sign of IEEE for that.
I hope you will be sharing this with Misam as well.
Yes, sir. Surely, sir.
Great.
Thank you so much, sir. Thank you so much.
Yeah. Thank you very much. Yeah.
Thank you.
Thank you. Thank you, everyone.
Thank you so much, everyone, for making this session interactive and inspiring one by showing such active participation, and we wish you a great day ahead. Let me share the feedback form with you all.
And a special thanks to all the mentors, faculty members, and most importantly to all the attendees for such a great participation. Thank you all.
Please do fill the feedback form, as your feedback is really very important for us.